I want to start and thank you for being here, by the way. It's great to see you in person. I want to start with that inflation data that we got this morning, combined with all of these concerns that we've been seeing about economic growth and the specter of stagflation that a lot of people have talked about, stagnant growth with still high or rising inflation. Does the report this morning lessen the risk of stagflation?
Well, good morning. Thanks for having me here today. So our base case, if you want to call it that, has been that we were on a glide path towards lower inflation. And as a result, lower interest rates over the course of time. That trajectory and the direction of travel continues, but the speed at which we're getting there has slowed down. And in the meantime, other narratives, in particular the uncertainty associated with some of the fiscal policies that we're hearing out of Washington, especially trade and tariff discussions, have then turned into the dominant narrative. And so as a result, what you're hearing and seeing is a change to market sentiment. And all of this is happening in real time at a pace of which we're not used to, particularly from Washington policy. It doesn't change our base case. Our base case continues to be one of a slightly slowing GDP, along with slowing global growth, and then also this glide path, if you will, towards slower means lower on inflation as well.
Nothing feels much like a glide path right now than the smoothness that implies, right? Because of all of the tariff headlines and the volatility we've seen in the markets. So your base case is for that, but I do know that your potential for a recession, the chances you're putting for a recession are higher right now than they usually are at 35%. How do you put that together, and are tariffs sort of the determining factor in that potential recession case?
So tail risk has definitely increased. And again, part of the uncertainty and the volatility. I mean, if you had to pick a few words to describe 2025, it also sort of sounds a lot like 2024, only more so. Last year, we were, of course, really worried about what was going to happen with the election. Now we had the election. Now we have to worry about what's going to happen between politics and policy. And this volatility is driving, again, as I said, the narrative. The other aspect that we're also not used to is a level of transparency when it comes to the level of negotiations that we're seeing out of Washington. And frankly, sentiment's going to drag in here because between now and mid-year, when we finally actually see Congress act and potentially pass the big, beautiful bill, put that in air quotes, then we're going to see a lot of this volatility because we're waiting for Congress to act. We're hearing and seeing all these executive actions and orders, and all of this is moving the markets in real time in a way that, frankly, markets don't really like. We like certainty, and we have a lot of uncertainty. And if you think about the four major sort of pillars, if you will, of the Trump administration, which is immigration, or what I'm tending to refer to now as reverse immigration, tariffs and trade, taxes and deregulation, all of this is playing out in real time, and it's moving markets because we're trying to react to all the promulgations. And frankly, the on, then off, then on, and then off again narrative is also challenging both stocks and bonds at this point in time. And so, yes, it doesn't feel like a smooth trajectory because of all of the noise.
What would tip us into recession at this point? Would it be if we don't, for example, get the big, beautiful bill, get the tax cut extension or additional tax cuts?
Quite clearly, if we don't see the policy implementation by mid-year, that could potentially slow down the economy much more. Right now, our base case is for, we'll call it 1.8-ish on real GDP. Trendline GDP in the U.S. is around 2%. So if we fall below that, then we get the slowing effect. And again, that's good for inflation, and we can see interest rates sort of fall relative to where we are today. By the way, we're in a trading range on the 10-year, sort of between mid-3s and mid-4s is about where we would expect ourselves to be. But if we don't see action and certainty begin to evolve in terms of policy, and then clear indications for the market, I think then what you end up with is business managers slow down CapEx purchases. They don't want to make investment decisions. And all of that then could increase the risk of that recession impulse in the economy.
I guess as a follow-up to that, if all that centripetal force is kind of around what's taking place in policy coming out of D.C. and waiting for that policy, then how does that impact investors feeling conviction to make a trade around a long-standing either technological shift or business trend that they can feel comfortable investing in?
Well, I think that's exactly what we're seeing right now. Measures of uncertainty, measures of market sentiment. It's the emotional reaction to what's happening in real time around us that the market's reacting to, and I think that then results in us dragging a bit more. And I had predicted this, and that's part of our base case as well. That's one of the reasons we think first quarter and into potentially early second quarter is slower relative to trend line. And then we'll have to see what happens with our friends in Washington.
How much repositioning is appropriate then, especially for a lot of the investors who I speak with are very overexposed to tech. They got in at 2020. They're used to double-digit gains. How much do they need to reposition to hedge themselves from any of the potential risks to the glide path you talk about?
Well, I think it's important for investors to think long-term and to look beyond some of the short-term volatility and noise and look to fundamentals. And the good news is that fundamentals aren't bad, and the growth opportunity and the themes still are alive and well. For example, artificial intelligence leading to productivity gains. This is a very important, very long-term trend. And you have to look beyond this sort of short-term volatility. You also have to think about the other, as I said, one of the 4 pillars of the Trump administration is deregulation. We haven't really seen that implemented yet. It's just beginning, and there's DOGE, and there's a lot of other noise within the Trump administration right now. But again, those long-term tailwinds are still alive and well, and we still need to think about them as long-term investors. So I tend to say, don't overreact. Think about what the impact is going to be. Also, other areas, manufacturing build-out, power, infrastructure, all of these trends in terms of the global changes that are happening, the reshoring into the U.S., all of this is a part of the long term. Think longer term.
Finally, I want to ask you a question away from the markets and about Guggenheim specifically. So you are Chief Investment Officer. The president of the firm, Dina DiLorenzo, another woman. I think about a third of the firm is women. We are in a period of time right now where there is this backlash against DEI and efforts to create a more diverse workforce. How are you guys thinking about this now at Guggenheim? Are you changing anything?
Well, we're certainly not changing anything because we think we're extremely well positioned. We've always had the viewpoint, because we have a very unique investment management process, which is team-based and collaborative, that multiple voices, differentiated voices, come together and develop better outcomes in terms of performance. And we've proven that year in and year out for the past nearly 2 decades that I've been with the firm, and has Dina. And so as a result, that we're not changing anything. We're going to continue on exactly the way we think about developing our investment process and our excellence for our clients. And that means lots of interesting and different opinions coming together.